All right, how's everyone doing? Yeah, that sounded about as exciting as it's gonna be. It's a beautiful weekend. It's gonna be awesome. So thanks everyone who picked up your papers. Look, we have a lot of papers that we've graded in the last 2 weeks. So if you're in the room today, do not leave before picking up your papers because my backpack is getting heavy. Everything is here except for half the midterms. And I think the response papers from Paul Odlin 2 weeks ago. We haven't graded those, but everything else has been graded. So they're in alphabetical order by letter, but not necessarily like within the M's. It's anybody's game. So pick up the whole letter and look for your papers if you would. We'll have everything done by next Friday and be back up to speed. I found a lot of the response papers really informative. I think you guys are doing a good job on these. I found the midterm really interesting too. So I continue to ask you guys to, when you do your response paper, I do want to hear the one con. You know, some people just kind of write about like the pro and then they forget to challenge anything, right? Because that's kind of easy. But I want you to be thinking critically and challenge some of this stuff. I can guarantee you there's plenty of flaws and holes in arguments. But I love kind of seeing the people go back and forth on that. So remember to put the challenge and the con in there as well. But by this time next week, we should everything will be graded and we'll be back up to speed. Sound good? All right, cool. So today I'm excited. Professor Kelly is not here. He's joining us by Zoom, so you might hear his voice boom in. But I'm here and I'm very excited to welcome Jimmy Atkinson and Andy Hagans. Jimmy's a class of 2004. Andy's a class of 2005. I think I'm going to let them talk a lot about their backgrounds, but what I've been able to glean is, and I've known Jimmy and Andy for about a year. We got introduced by someone else within Notre Dame that said, you guys got to meet. These guys are serial entrepreneurs. And I think that's really interesting and great to learn from. And they've been entrepreneurs in various different elements in their career. They started a financial media company, sold that, became investors at that point. We're looking at the investment options out there. And like there's plenty of you can do with ETFs and mutual funds, but they're more interested in alternatives. Kind of what we're talking about in this class, real estate, private equity, VC. And what they found was there weren't a lot of opportunities for the high net worth investor, for the person who didn't want to just buy ETFs and mutual funds, but actually want to make direct investments. So they started a company around it, which is pretty cool. Now they have Wealth Channel and a variety of other companies. They have a variety of different podcasts that they do, conferences, and solely empowering, or not solely, but really working to empower the individual investor. And so I can tell you, if you see me walking across South Quad and I got my headphones in, I'm probably listening to one of their podcasts. I consume it. I find it interesting. I learn something every time. They do a lot with opportunity zones, which they're going to talk about. Opportunity zones is a part of real estate we haven't talked about yet this semester. And I just think they've got a great wide variety. So with that, I'm going to hand it over to Jimmy and Andy to walk through things. At the end of the day, I think these guys are going to be very relatable to what many of you guys want to do. Reading in your papers, many of you want to start investing now. So throw up a hand if you have a question. I'll try to get the microphone to you. If I don't, just boom out a question, but they want it to be interactive as well. Sound good? Any questions before we get started? No? All right, let's roll. Guys, all yours.
Thank you. Mike, it's a pleasure being here today. Thank you so much for the invitation. It's a pleasure to be speaking in front of all of you today. Who's ready for some Irish football tomorrow, huh? There you go. Go Irish. Hopefully that's the best thing that happens this weekend. We want this to be the second best thing that happened this weekend. So we're gonna be talking about trends and alternative investments and real estate, private real estate. We are investors, as Mike alluded to, and we'll be talking a little bit more about our backstory, and then we'll dive into the meat of the discussion in a moment. Now my clicker's not working, Mike. Yeah, it was working before.
So we just need to put the mouse here.
There you go. That's working out. Great. Quick legal disclaimer our lawyers want us to read to. This is not legal advice or tax advice. Always consult a professional before making any investment decisions. We are Wealth Channel, as Mike mentioned. We are a media and events company. Wealth Channel is. We got our start about this particular company. Wealth Channel was founded by us about 5 years ago, primarily to focus on opportunity zones. And I'll talk to you about opportunity zones and its implications for real estate investing a little bit later in the presentation. But we also have an interesting backstory. We met here on campus. Andy, tell the audience a little bit more about us, how we met and how we got going with Wealth Channel.
Is that 2001?
Yeah, 2001-ish, yeah.
2001 we met, we were roommates, right? So I'd never met Jimmy before, just, well, no, we were next to each other.
Yeah.
Yeah. And we've now been business partners through at least 5 companies over the past 20 years. So we started in Stanford Hall, literally started our first business in our dorm room. That one didn't make a ton of money, made a little bit of money, made some beer money. But one led to another, it led to another. We ended up co-founding a company called ETF Database, which at the time, around 2012, it was the largest independent media covering exchange-traded funds in the United States. Sold that, built another company, scaled that, sold that. So we are serial entrepreneurs, love working together. We just have fun. That's kind of really what keeps us together, I think, for the long haul. So I've known him for 20 years, longer than I've known my wife. And it's funny when you work with someone that long, you know, you're almost like an old married couple. Like you have like a secret language. So if I'm talking and like a slide changes, that's his communication to me, like, hey, dude, you're talking too much. It's like our own secret language. But anyway, we love what we do. We love working together. If you find a good partner or a good spouse, it's a blessing, right? Hold on to him. Jimmy?
Yeah, and I've been married to you longer than I've been married to my wife as well.
There you
So,
go.
any Stanford Hall men in here? We got our start in Stanford Hall. There you go.
Right.
Couple. Good. All right. We're fortunate enough to collaborate with a variety of different leaders in the alternatives investments industry. This is just a handful of the groups that we've worked with. We've worked with dozens, if not hundreds, over the past 5 years. We want to take today to contextualize. We know that this is the Fitzgerald Institute for Real Estate, so we're going to have a real estate focused presentation. But what we're trying to do today is contextualize how real estate fits into the broader alternatives universe and how investors, high net worth investors, the ultra wealthy and family offices consider real estate as part of their overall portfolio. Because without investors, real estate doesn't get built. So we define what an alternative investment is by, first of all, defining what it is not. So it is not a traditional investment being what you would typically find in your brokerage account, stocks, bonds, cash or cash equivalents. A couple of characteristics of alternative investments. They are generally illiquid. You can't load up your stock brokerage account on E-Trade or Fidelity and buy and sell alternatives at the click of a button. And they're often referred to as private investments. And then the benefits of alternative investments. Andy's going to go into the specific benefits in a moment here, but just to touch on them briefly, there's a lot of benefits of investing in alternatives. The 3 key ones that we've identified are: 1, portfolio diversification; 2, there are tax benefits associated with alternatives frequently; and then 3, enhanced returns. So Andy, why don't you give us the scoop on portfolio diversification, how alts can help an investor diversify his or her portfolio, and why is it important to diversify a portfolio?
Yeah, so Jimmy covered the what. I also like to start with the why. Like, why do I care? Right? Traditional investments, stocks and bonds, ETFs, mutual funds, index funds, things that hold stocks and bonds. So traditional investment, I can sell it on an exchange, get liquidity that very day. So if you're anything like me, things become a lot more interesting when you have skin in the game, right? So a couple months ago, I made my first investment in an oil deal. And suddenly I care about oil. Like, I never cared about the price of crude oil before. Suddenly I care a lot, right?
I've never heard him talk about oil as much as he has in the past few weeks.
Right. So quick question for you all. Are any of you investors already? Your teacher was telling us that some of you are already like buying up rental real estate or, you know, investing. Raise your hand if you're already.
Maybe you just have some money in the stock market.
Anybody?
Any investors?
Okay, that's a good amount.
Good handful, maybe half or so.
Yeah, and then I'm guessing a lot of you plan to be an investor, right? Me, it took a couple of years after I graduated. I wanted to pay off my student loans and I started investing. But this is the why. Why do I care about alternatives? Why not just be happy with the 60-40? Well, the first reason, probably the most important reason, is portfolio diversification, right? It's the only free lunch in investing, diversification. You diversify a portfolio, you're essentially lowering its risk without lowering its returns. If you know the efficient frontier theory, efficient market hypothesis, right? A higher risk adjusted return is better for the investor. So that's the first benefit, is you had two asset classes in a typical portfolio. Now, if you have real estate or some of these other alternative investments, now I have more than two asset classes, right? Diversification.
And then I think I was going to talk about the tax benefits.
Yeah, this
right?
is Jimmy's wheelhouse.
Yeah, this is in my wheelhouse. The tax benefits of alternatives. And the way I think about tax benefits is in three different ways. And taxes are so crucial, by the way. A lot of people ignore taxes. It's just something that they have to pay. And it's true, right? There's only two certainties in life, death and taxes. But to the extent that you can mitigate taxes to increase your returns, all the better. So three different ways I like to view the benefits of alternatives in terms of taxes. There are certain tax benefits that are inherent to certain alternative asset classes. So with oil, there's intangible drilling costs and depletion. With real estate, there's depreciation. Those are a couple of examples. The second way I like to look at it is tax credit programs. There are tax credit programs that you can layer into the capital stack of certain real estate investments, affordable housing tax credit, historic tax credits, renewable energy credits, which recently got renewed as part of the Inflation Reduction Act just last year. And then the third lens through which I like to view the tax benefits of alternatives is tax advantaged vehicles or wrappers, a structure that you can wrap an investment in, such as a Delaware statutory trust or a 1031 exchange, a REIT, or opportunity zones. We'll be talking more about those as we go along here. And then the third big benefit of investing in alternatives is the ability for enhanced returns. And you're taking this one.
Yeah, that's probably my favorite aspect of alternatives, right? Who doesn't like money? Alternatives can make more money. And really, there are two aspects to this. The first aspect is within the asset class itself, the illiquidity premium. And I put this book, the Ivy Portfolio, big picture of this. I read this after I graduated, actually, and it really captured my imagination. The author, Ned Faber, I ended up having him on our show, Wealth Channel. He was kind of early. He was like, I think, way ahead of the game here, talking about how the big endowments at Harvard and Yale, they were buying up, allocating a huge portion of their endowment. These are huge endowment funds, right? To illiquid alternative investments. The reason they could do this is they didn't need the liquidity, right? If you're age 64 and you're a year away from retirement, you can't afford to be invested in things with a 10-year, 20-year, 30-year liquidity horizon, right? Because you're about to retire. But if you're Yale or Harvard, your time horizon is essentially infinite, right?
Or Notre Dame. Let's not leave out Notre Dame.
Yeah, let's not leave out Notre Dame. Notre Dame has a big endowment.
I think it's the 7th or 8th largest endowment among private schools. It's about $18 billion. Is that right? Somewhere in that range? Yeah. 19. Okay, sure.
Must be a good year.
Yeah.
Yeah. So the idea is, if you're willing to go illiquid, you can demand a higher return for your investment in return for willing to be illiquid. It's considered to be more risky to have an illiquid investment. But again, if you don't need the liquidity, you can afford to take that risk. You get paid to take that risk. And this is really what kind of planted the seed in my mind, the passion, reading about the Yale Endowment Fund buying timber, just like huge forests. And I'm like, that is so cool. You can go buy a forest. That's an investment. It just like really stuck with me. I'm like, there's a lot of cool stuff going on in the investment world that I never even heard about. Secondly, though, that's within an asset class, right? So within equities, within credit, within real estate, you can earn that illiquidity premium by making a private investment versus the public investment. Secondly, with the overall portfolio, you're more diversified, alternatives lower the portfolio volatility. So it's higher risk-adjusted returns for the overall portfolio. And this graph, you can find someone who might question the math because a ton of people have done studies on this. Will a portfolio with alternatives outperform the classic 60-40? And you'll find different numbers depending on who you ask. But generally, it's becoming increasingly mainstream, increasingly accepted among advisors, among academics, people like your very smart professors, that including alternatives in a portfolio does indeed increase its returns over the long run. So we're going to go into the major alternative investment asset classes because I realize, some of these things, we use these terms, we don't define them. If you're not into private equity, for instance, you might not even totally understand it. We're going to go through the big four, circle back to private real estate. Obviously, that's our biggest topic today is private real estate. But I want to talk through what all these asset classes are. Because you got to understand with investment real estate, this is the big picture of how all these asset classes are getting financed, right? If we can't raise the capital, the debt, and the equity for these big projects, they don't get done. So again, we're going to start with private equity. And easiest way to think of private equity, right? It's owning a stock, owning equity in a company, but not in the public markets. Right? So a stock publicly traded on the New York Stock Exchange or the NASDAQ. If I want to sell it, see what time is it? It's 11:19. I can open up my iPhone, I can sell it in 30 seconds. Right? If you own Wealth Channel or one of the private businesses that I own, if I want to sell that, if I'm lucky, it might be a 6-month lead time, right? If I'm lucky, and it might be like a 5-year lead time. So it's an illiquid ownership component in equity. That's private equity. All kinds of different strategies, leveraged buyouts, growth private equity, venture capital is a form of private equity. So all kinds of different strategies, but what private equity refers to is I'm owning this equity privately. I can't just go to the New York Stock Exchange and sell it at any given time. Private credit, really the same thing, same concept, right? It's a form of debt, a form of credit, not a bond, not something that I can liquidate, not a bond fund, but I'm owning it privately. Private credit, by the way, it's having a mini golden age. I think our next slide shows some of these yield spreads because interest rates, bonds are paying much higher interest rates right now, right? It's finally good to own bonds, in my opinion. So the interest rates are higher, but now by being illiquid, and you can see it visually here, you can see the illiquidity premium, right? I'm getting paid additional interest, not only because interest rates are higher, but I'm getting the spread if I'm investing in private credit, right? So I'm friends with a GP manager in a private credit fund, and he's like, our goal is to pay 10% a year. His fund is so conservative. He's a banker. He's a total opposite personality of me. I'm like, I want to shoot from the hip. I want to take some risks. Let's go play blackjack. That's me. This guy's like the total opposite, and his fund is still paying 10%. So it's a very good time right now for private credit. Next,
one thing I did want to point out is I think the numbers on this slide might be out of date. This might be a year old, this slide. I think you can expect all those numbers have probably shifted to the right with the increase in interest rates over the last 18 months. Just want to point that out, but the concept is still the same.
Absolutely. Yeah, higher interest rates, it can be good or bad, right? It's harder to get real estate projects financed right now. On the other hand, again, if you're invested in private credit, if you're buying bonds right now, it's a good time to have high interest rates. Hedge fund, question.
Yeah, one thing that's really interesting about private credit for those of you who haven't seen it before is to lose money as the lender in private credit, it means the equity lost all their money. So equity is always in the first loss position. The first person to lose money is the person who owns it. The bank always gets paid out first. And as a private credit lender, you're effectively the bank. And so to Andy's point, if you can earn 15% lending to someone and you have this cushion of the equity that would lose all their money before you, that feels really good. So that's why it's going through this renaissance, because interest rates are so high. It's really attractive.
Absolutely. I mean, there's even secured private credit where it's asset backed, where you don't make the payment, guess what? Now I own a jet, because it was asset backed. Hedge funds, just going to cover these briefly. These are a little bit of an exception to some of the other stuff we're talking about today. We talked briefly about Harvard, Yale, these endowment funds moving into private assets, alternative investments. That was really happening in the 70s, 80s, 90s, even a little bit still kind of happening in 2000s. Hedge funds were another asset class they're heavily invested in. But some of those other asset classes, private equity, private real estate, private credit, they're becoming more and more democratized, more owned by accredited individual investors, kind of your everyday millionaires. Hedge funds are still have a very institutional capital base, right? So this is more like billionaires and very large organizations invest in hedge funds. To define hedge funds, it's actually not easy. The first sentence here, I got this from sec.gov. Hedge funds pool investors' money and invest the money in an effort to make a positive return. I'm like, that is so broad and vague to be almost meaningless. I added the second sentence here. They may invest in traditional investments, but with alternative strategies. So they're a little bit different than like private real estate. It's talking about real estate as an asset class, right? A large apartment building is not bought and sold on an exchange. Well, hedge funds, they can't own nothing but common stocks or other derivatives options based on common stocks, right? But they might be market neutral, right? They might buy 100 stocks in the S&P to own, and then they might short another 100 stocks in the S&P. So it's a market neutral fund. They're betting that some will go up and some will go down, right? So they're attempting to earn this positive return that's not correlated to the overall market, but they may be using nothing but liquid securities to do so. Does that make sense? Couple nods, okay. Not going to spend too much time on this, but the timber, as I alluded to before, these are big projects, sometimes even that states are trying to get financing for: toll roads, transportation, water and waste. A lot of times these will be financed by pension funds, by large institutional investors, essentially off market with private investments. Oil and gas is a big one, having kind of its moments in the sun right now. And I think that brings us back to real estate, which is, I know why most of you are here, right? For real estate, for the real estate.
So we're going to be talking about real estate for the bulk of the remaining time in the presentation today. But it was important to cover those other asset classes, those other big asset classes within this broad bucket that we refer to as alternatives, and how investors consider real estate as just one of many asset classes within that big bucket. It's one of the biggest ones. It's probably the most popular among this crowd, at least is the most popular among us, although he likes oil and gas quite a bit now. The two ways I like to view private real estate from a very high level. One, you can look at the different sectors, and two, the different investment strategies. So the sectors, there's a lot of sectors. I've got 4 listed here. These are referred to as the top 4, I think, or the key 4. You can slice and dice in different ways, but housing is the top one: multifamily apartments, residential, single family rentals, build to rent, and then subtypes within that big category might include senior living or student housing, right? Second big category is office. Offices having a rough past few years because of the pandemic. Depending on who you ask, it may be bouncing back, or maybe it's long dead forever. We don't know. Time will tell. Industrial and warehouse is having its moment, due in part to the pandemic, actually, and more people buying online, warehouse distribution centers needing to get built all over the country, Amazon and other e-retailers needing to build more industrial and warehouse in certain key locations. And then retail is the 4th major sector, as defined by iCapital, by the way, is the source that we're using here for this one. In terms of investment strategies, I've listed these from top to bottom in terms of most stable and least stable, or highest or lowest risk. Core is lowest risk, lowest potential for return, and then opportunistic development is highest potential for return, but also highest risk. So when you're investing in a core real estate asset, it's typically something that's pretty stable, already cash flowing, already leased up. Core plus and value add is kind of that middle ground where the property might need some improvement. So there's a little bit of risk, there's a little bit of rehabilitation risk. Maybe the rent roll hasn't come up to speed. You've got some vacancy issues, improving the property essentially. And then at the bottom is opportunistic or development. Some people split these out as separate, but we were talking about either substantial rehabilitation of an existing property or ground up construction. The most risk, the most illiquid, you're locking up your investors' money for years, 2, 3, 4, 5 years before they see any sort of cash returns, but also the highest potential for returns on the back end. All right, I love tax advantage real estate, which is why Andy convinced me to put this emoji on there. This is really my baby. I am the founder of Wealth Channel, but prior to Wealth Channel, I founded a platform called Opportunity DB. And I'm also the host of the Opportunity Zones podcast. And so Opportunity Zones we'll dive into in a few minutes here, but I think it's the greatest tax incentive ever created for real estate investors. But there's all these other types of tax incentives or tax wrappers for real estate investors that we'll go through quickly here. Section 1031 exchanges, Delaware statutory trusts, OZs we'll talk about momentarily. Then there's also private and non-traded REITs as well that have their own inherent tax advantages to them. Show of hands, who here has heard of a Section 1031 exchange? Just curious. Okay, a good portion of you, about half or 2/3 of you. Many of you in here, maybe you've started doing 1031 exchanges, or you have family members that are doing or have done Section 1031 exchanges. When you sell an asset for more than you acquired it for, you create a capital gain, and then the government comes and then they tax that capital gain. So if you buy a property or any other type of asset for $10 and then you sell it for $12, you've got a $2 capital gain, and Uncle Sam says, hey, I want my 50 cents or whatever the tax rate is. The Uncle Sam's going to come in and take some of that money from you that as a capital gain tax. So a Section 1031 exchange allows you to transact a real estate investment property and acquire a new one without paying that capital gains tax. It's essentially a indefinite deferral strategy. It's also referred to colloquially sometimes as a swap till you drop mechanism. If you do this throughout the course of your investing career, you start small, maybe you start with a duplex or a single family rental, and then you can continually trade up into different properties through Section 1031 exchanges over the course of your career. Maybe by the end you have a portfolio of properties, you've never paid capital gains tax on any of them. When you pass away, your heirs inherit your real estate investment portfolio. The basis steps up to fair market value, which is French for they never pay taxes on it either. So the capital gains taxation is actually never paid at all. And there's also a special type of 1031 exchange called a Delaware statutory trust, or a DST, or a 1031 DST. And those are essentially fractionalized passive interests in larger, more institutional quality real estate. So you can come in, instead of being an individual investor in one property that you're directly owning and operating, you can come in as one of maybe 100 or so investors into a medical grade hospital building or some other large building or portfolio of large buildings. So you get that institutional quality, you get passive ownership, you're not the one managing it anymore, you're paying a management company to do that for you. I'm gonna spend the next, yes.
Yeah, just one thing about taxation, because I'm like you, I'm kind of a geek on taxation as well. Like, no one wants to pay more taxes than they need to. I think we can all agree with that. You want to get the best tax treatment possible. And so that's the first thing, is being able to minimize your tax burden. But the second thing is the longer you defer payment of taxes, the more you get to compound the money that's working for you. So you can either sell an asset and have $100, or you can sell an asset and still have $150. And that 150 compounds at a meaningful way, sometimes for decades. And so some of these strategies that they're talking about, it's not just about minimizing the tax, but pushing it out and using compounding to your advantage for your entire career, which your entire investing career, and after you die sometimes, in the example you just gave. I think that's, when we talk about taxes, we're not just talking about trying to pay as little as possible. We're trying to defer them as far as possible as well.
That's a great point. And opportunity zones are great at doing that. I'm going to spend the next few minutes talking specifically about opportunity zones, because The Section 1031 exchange has been around for literally 100 years. Opportunity zones are a brand new tax incentive. They were only passed into law as part of the Tax Cuts and Jobs Act of 2017. And they really didn't start existing until the middle of 2018. It's a perishable tax incentive. And it's a place-based policy that's meant to drive investment into low-income communities all over the country. And I think it's going to be, if it isn't already, the greatest economic development program in US history. And I say on my podcast all the time that it's the greatest tax incentive ever created. And Andy, I'm gonna turn to you actually, because I want to ask you the way that you think about returns as an investor. You always talk about triple net returns. I would kind of want to pile on what Mike just said about how important it is to think about after tax. What do you mean when you say triple net typically?
So you have your gross returns, right? So let's say the S&P returns 10% in a year. That's your gross returns. Now, the three things you need to net to find your net return. First of all, fees, right? So if you're buying that S&P fund through an ETF or mutual fund, they all have different fee structures. You want to minimize the fees that you're paying, right? Second is taxes, right? That's something that can be under your control somewhat if you engineer your strategy in the right way. The other thing is inflation. That's totally out of your control. But I think it's important to note, you know, with triple net returns, you're taxed on your gross returns. So let's say you own a bond fund that's paying 10% a year. Okay, you're taxed on that nominal returns. So you're paying, let's say, 30% tax. So you're paying 3% out of that 10% you're paying, right? What if inflation is 10%? It just pushed your triple net returns negative, right? So you're actually losing money in terms of purchasing power on a real basis in that scenario. If you're an institutional investor, you don't have to worry about taxes, right? So a lot of this tax stuff that we're talking about, it's mainly relevant to individual investors or financial advisors who are representing individual investors. So really, if there's one concept that I'm really focused on, it's analyzing every investment triple net. Back to private credit, 10%, awesome yield. I have to pay 43% tax on that? No, it's not so good anymore. If I'm the Yale Endowment Fund, it's great. For me, no thanks.
Thank you for that. I hope that helps contextualize why I like opportunity zones, why they're so important, because they get after the tax part of that triple net returns. As I mentioned, it's a place-based economic policy program. In order to qualify for the tax benefits of being an opportunity zone investor, or maybe you're a real estate developer and you're trying to raise equity from investors in order for them to qualify, the project or portfolio of projects needs to be located in one or more of over 8,700 low-income communities. These are designated at the census tract level all over the United States. There roughly 35 million people live in these blue shaded areas all over the country, covering, I think it's about 10% or so of the landmass of the country. They're in every state in the country. They're in Puerto Rico, they're in Washington, D.C., and there are even some here in South Bend. So I pulled up the opportunity zone map of South Bend. You can see where Notre Dame is there on the top right. And just across the street, if you walk south of Angela Road, you're in an opportunity zone. And if you were to do a new construction or substantial improvement of an existing building in any one of these blue shaded areas, you and your investors would be eligible for all of the tax treatment that comes with being an opportunity zone investor. And I'm going to highlight an example of a project that I'm very familiar with on Notre Dame Avenue in just a minute here. Well, what are the opportunities?
Who decided where the opportunity zones were drawn?
Oh, great question. Yeah, great question. In 2017, the Tax Cuts and Jobs Act was passed under President Trump. And then that following year, there was a 6-month period where the governors of every state, plus the governors of all the overseas territories, plus the mayor of Washington, D.C., they were all able to nominate their list of low-income census tracts. And they had to meet certain eligibility requirements that I won't get into the nitty-gritty, but suffice it to say, they had to be low-income census tracts. They were able to designate up to 25% of their total jurisdiction state territory, Washington DC, to the Treasury Department. And then the Treasury Department certified all of them that summer. And that's when the map that I showed a couple slides ago here went into effect in the middle of 2018.
So these governors basically were saying, nobody wants to invest in these areas, or we're not getting much investment because they're kind of blighted, low-income areas. Let's turbocharge this by giving people a tax break.
Correct.
Or deferral. And then people will start putting money in these areas because everyone likes saving money on taxes.
Correct. And these are areas that were typically overlooked by private investors. They had not recovered as well from the Great Recession of 08 and 09, like a lot of the wealthier parts of the country. So that was the policy reason behind creating this tax incentive, which I'm going to walk you through. And there's a lot of nuance to the tax incentive. I don't want to put anybody to sleep too early here. So, this might be more interesting to some of you accounting or finance majors in here, but suffice it to say, it's a tax incentive that allows anybody who has triggered a capital gain to then roll that capital gain over into an opportunity zone investment. And then if that investor holds that opportunity zone asset or portfolio of assets for at least 10 years, you get to never pay capital gains tax on the appreciation of that opportunity zone asset. So if you invest $1 million into an opportunity zone development project and it grows to $2 million, you've got a $1 million capital gain. You'd normally pay $250,000 or more in taxes. In this case, you don't pay anything. You pay zero tax. It's essentially, I like to refer to it sometimes as a super Roth IRA, if you're familiar with IRA structures. It's unlimited tax-free growth, the potential for unlimited tax-free growth. So I want to take a few minutes now to highlight some actual projects that are being developed with this program that likely would not have happened or would not have happened as quickly, but for this economic development program. So the first one I'm going to highlight is Veterans Villa. This is a multifamily development. It's actually a mixed-use multifamily and entrepreneurial business center development project that is underway in Colorado Springs, Colorado. This is specifically designed to serve our nation's armed forces veterans when they come back from their deployments. Sometimes they don't have anywhere to go. Sometimes they don't have skills to start their own business, but this is a small business center that includes some workforce training and some advising and also some housing for some of our nation's veterans. This one's under construction right now. You can see a rendering of it right there in Colorado Springs. Second one is Monterey Globe. I actually just had these individuals on my podcast last week, I think it was, or earlier this week, it was a couple of days ago. This project I like because it has Catholic roots. The founders of the project are Catholic, and it is a for-profit project, but they are taking some of the profits from the project and tithing it into their related nonprofit entity that is going to provide some free housing for retired religious clergy, Catholic clergy, but also other denominations as well. So that's a really cool project that's happening in Globe, Arizona, about an hour east of Phoenix, if you're familiar. And then right here in town, in South Bend, Indiana, I showed you that map on the couple slides previous, just south of campus, that blue shaded area. We've got an opportunity zone project under development with a good friend of mine. We actually went to the Notre Dame BYU game together, sat together in Vegas last year, and he was telling me about this. And I said, man, if I ever get in front of Notre Dame, I'm going to tell them all about this project. So this is a old medical building conversion project. This medical building had been sitting vacant for about 15 years. It was a blight on the city, and they are using opportunity zone equity from high net worth investors and family offices. And Kirk is my friend. He has his own family office and they're pouring capital into this project, and they wouldn't have otherwise but for the incentive. 511 North Notre Dame Avenue, around the corner of Notre Dame and East Cedar Street, I believe. So
it's like right next to St. Joe High School.
It is, yeah, it's right next to St. Joe High School. And this one's probably going to be the most impactful potentially for the people in this room. It's adding more housing stock to South Bend. Hopefully that'll help drive down the rents a little bit, or at least decrease the rate of rent growth more likely. And maybe one or more of you will actually live in this facility in a couple years when it's completed. I know they're pre-leasing it right now. So that's what's happening right here in South Bend.
Hey, Jimmy.
Yes.
Sorry for interrupting.
No, I love it. Keep it going.
So last week we had Paul Odlin in here who
Mhm.
talked about affordable housing.
Yes.
So that was for folks that, people who live there, the residents, they don't pay market rate.
Right.
The Hill, that's market rate housing.
Yes.
The benefit is to the owners. They're going to charge as much as they can in rent for students. So this is not an affordable housing program in any way, shape or form like
Correct.
last week. This is 100% a benefit to the owners, market rate housing.
Correct. If I can just say one more thing about that. You're absolutely right about that. This is not an affordable housing program, although, and I like to talk about affordable housing in two ways. I like to talk about capital A, affordable housing. That's when you're actually acquiring affordable housing tax credits from, I think it's HUD that distributes those. And then there's lowercase a, which is affordable because it might be it's market rate, but maybe it's a little bit smaller. It's built to be affordable, essentially. It's not meant to be luxury housing. It's also called workforce housing. Your nurses, your teachers, your police department, your fire department, those types of individuals typically live there. And frankly, we have a shortage of housing in this country, right? I think depending on who you ask, we've got a shortage of about 5 million units in this country. So this economic development policy helping to address some of those needs. So that's real estate, and that's opportunity zones specifically, which is my area of specialty. Thanks for indulging me. Why is all this important? Why are we so passionate about it? Well, there's some really heavy tailwinds kind of carrying the growth of alternative investments. So Andy, you're going to talk a little bit about the trends in alts and why they're growing and how much they're growing.
Yeah, and this is a good thing for real estate, right? That we had institutional investors who were investing very heavily into real estate. And now that tailwind is spreading to the retail market. When we say the retail market, what we just mean is individual investors. Before I go into the trends, why don't I just pause? I want to get at least one question from a student. Make sure somebody's awake. Just one. I'm going on strike. Do I need to call on somebody?
I was wondering, from your stock opportunities, we sound that there's a results oriented investment, and you're kind of investing these lower income communities just to get returns and all of the social impact.
Yeah, no, great question. He was asking essentially, correct me if I'm wrong, he was essentially asking, this is a program that's meant to drive returns for the investor, right? What good is it doing? I think is kind of what you're asking, right? So back to this project, the Hill Apartments in Notre Dame. I actually asked the developer that question. I was on the phone with him a couple of days ago. I told him I was going to be speaking here. I asked him, hey, how is this actually helping South Bend by building more student housing? And one response he gave me a whole list of reasons. I can't remember them all, but one of them was, first of all, he is providing some jobs, right? He's providing construction jobs to local construction workers to get this project done. Two, he's going to increase the rent rolls in this city, and he's going to increase the tax base for the city of South Bend. Now, the city of South Bend is bringing in more revenue also. Those are two key ways that opportunity zones can help by providing construction jobs up front. And then, if it's an apartment building, maybe there's not a ton of jobs that go along with apartment buildings, but maybe it's a retail center, or maybe it's a hospital, or, it's providing more jobs on an ongoing basis. And then thirdly, these types of development deals can oftentimes be catalytic, right? If you have an old hospital building or an old medical building like this was, and it's run down, it's been sitting there vacant for 15 years, it's not making any revenue for the city, it's a blight on the community too. So nobody wants to develop next to it. You improve this, it can be catalytic. Now suddenly, hey, wait, what's going on in this street corner? Let me come and put a retail center down the street, and it can kind of snowball. You see what I'm saying? So that is a common criticism of the program, is it's just a tax break for the wealthy. And it is a tax break for the wealthy, but it's designed to be a tax break for the wealthy to incentivize them to invest in these areas, to spur more investment into eventually the more economic revitalization in these areas, the better.
Jimmy,
We had
can
a
I-
question. up
Sorry, I
there.
just wanted
Go
real
ahead.
quick to add on to that. I think it is true, a lot of private investors are not investing in opportunity zones because of social impact. I know that because I'm an LP in multiple opportunity zone funds. I did not invest in them for social impact. I'm just being honest, right? I'm not gonna pretend like that's why I invested in them. One of the things I love about this program, it was bipartisan, meaning Democrats voted for it, Republicans voted for it. And I think part of the reason was free market type people said, you know what, this is great, it's a tax incentive. We can make money by investing in these opportunity zones. And the more socially impacted minded people said, this is going to bring private investment dollars to places that desperately need it. And so I think this is an example where you don't even necessarily need to have a good intention to bring about the good result, right? I mean, it's kind of a theory underpinning capitalism. If you can constrain it, right? If you can orient it with regulation, that good can come about, even if people have impure motives, right? As a Catholic, I guess one thing I love about Catholicism, it acknowledges our human nature, right? If I can be philosophical just for a second, we have concupiscence, tendency towards sin and greed and selfishness. And so I think a lot of the investments in OZs are coming from a selfish place, but at the same time, they're getting workforce housing built that otherwise would not be being built.
Hi, to get down to the numbers or to like the risk adjusted return, like was referred to, I'm wondering about a few factors if you can maybe address. So with opportunity zone projects and affordable housing, one thing that comes to mind is you might be taking on the increased risk of tenants, you know, whether that be with vacancies, the need to evict tenants, or problems in general that arise from that. And another problem I was wondering about was with a 10-year essentially holding period required to take advantage of the zero tax opportunity, that advantage is kind of lessened when you compare it to the ability to defer taxes almost infinitely through the 1031 exchange and so on. So I'm wondering, you know, with those extra risks in mind and those inherent costs, how do these projects, you know, opportunity zone projects and affordable housing projects compare to other strategies or types of assets in real estate, such as, you know, just going straight to how do you say, like full market price rental outside of these zones without many of the same regulations and red tape around it?
No, great question. Well, I think part of your question was how does OZs compare to doing a 1031 exchange? Why would you do an OZ versus a 1031? 1031 can allow you for deferral for the rest of your life. Part of what attracted me to opportunity zones was the fact that I didn't have to wait until I pass away before I achieve the full tax benefit of the program. Like Andy, I'm an investor in multiple opportunity zone funds as well. 1031s and opportunity zones, there are a lot of similarities, but the strategies and the risk return, where they fit on the risk return spectrum is totally different. Opportunity zones by law have to be opportunistic, heavy rehabilitation projects like the Hill Apartments, the medical office building conversion, or new construction. 1031 exchanges, and particularly DST, the passive form, are typically more stable cash flowing, or they can be, and they usually are more stable and cash flowing immediately is why you'd want to do that. So it kind of depends on who you are as an investor, what your investment horizon is. We have a slide on one of our other presentations that we don't have available today that actually drills into, like, I think there's 10 different dimensions of opportunity zones versus 1031 DSTs. Maybe I can add that to the deck if anybody is interested in seeing that. We stripped it out of here because we wanted to keep it high level, but did I answer? I answered one other question, I think.
One other part of your question, I think, you know, the increased risk with affordable housing type investments, those typically have much higher cap rates, right? So if you invest in affordable housing in the south side of Chicago, you might be getting like a 10 cap, like a 10% return. And in return for that, you're dealing with much higher risk or higher headache, frankly, the 3 T's in real estate. If y'all are in the real estate program, I hope you know what the 3 T's are, right? Toilets, tenants, and trash. I don't know if they taught you that. They should teach that here. It's probably like the first thing you learn in real estate on the ground level, right? If you go buy a duplex. Opportunity zones typically are building like workforce housing or more kind of mid-range housing, not actual affordable housing, capital A affordable housing. So to your point, economically, that's where actually the supply demand mismatch is the greatest in the United States. You probably know this already, is in middle class housing, right? Especially in cities. So we're both LP investors in Origin Investments. They have an opportunity zone fund. They're building multifamily, and it's kind of that middle market multifamily, huge shortage of it. There's always risk with an investment, but if you're building a workforce multifamily in an area with good demographics, for me, it's as close to a no-brainer as you're going to get, as long as you're investing with a competent manager. What do you think about that, Mike? Does it?
Yeah, no, I think it's a great point. And I also want to go back to something you said, Andy, which I thought was very candid, which is you invest in opportunity zones because of the tax benefit. Like we're capitalists. We want to have more money in our pocket to invest future. But here's what happens. And I see this in my hometown of Austin, Texas, is there's an opportunity zone. People start investing. This program's been going on for 6 years now. People start investing and building out multifamily housing in this area. Well, guess what? Now the city says we have to build a new school there. And now anyone who lived in this blighted area before, they now have money from the school district coming in that was never going to go to that area of town before. And so while you and I don't necessarily invest as a affordable or as a charitable program or a mission driven, there are spillover effects that are real, so that the family that's lived there for 20 years and hasn't seen a new school book arrive on that campus or a new, the gym hasn't been repaired or the library, all of a sudden the school district now has to invest in this area because there's people living there. There's more people living there. So there is a benefit. I think that's a big reason why this program got developed, was all the social services pick up as well, which benefits everybody. And that has nothing to do with the tax benefits.
That's why they developed this as a tax incentive and not some tax credit program. They saw that going back to the beginning of 2018, when this program was first rolled out, some organization, I forget who, analyzed the amount of unrealized capital gains that were being held on the balance sheets of individual investors and corporations. And it was $6.1 trillion. And it was just sitting there in terms of, highly appreciated growth in the stock market primarily. And so these policymakers in Washington, D.C. were, and by the way, it was spearheaded by Senator Cory Booker and Senator Tim Scott, Democrat from New Jersey, Republican from South Carolina, truly bipartisan. They wanted to incentivize, hey, how do we unlock that $6.1 trillion of capital gains? How can we get people to divest some of their assets and roll it over into privately into low-income communities all over the country? And that's why opportunity zones were born. They knew they had to dangle some carrot that was enticing to investors, and it was going to be market rate returns and a huge tax benefit to boot. So
absolutely. Well, let me get through this, and then maybe we can do a few more questions. Wanted to circle back to some trends in alternative investments. So this is what we titled our presentation. The first several slides were kind of like alternative investments 101. Just wanted to cover everything, make sure we had our vocabulary straight. Alternatives are a huge story right now in the investment world, right? Because again, they're growing. They're also democratizing. Portfolio models are changing. And we're going to talk about a challenge as well. But I want to start with the growth. So again, in the 70s, 80s, 90s, 2000s, you had institutional investors, you had endowment funds who are investing in alternatives. They might have a target in their portfolio for like a 20% allocation. And then they decide over time, no, let's have 50% or 60% in alternatives. And so that's a huge tailwind because they're, investing literally billions of dollars, right, at a time into this asset class, into these different asset classes. Then you have family offices start to do the same thing on a slightly smaller scale. By the way, a family office, should probably define that, basically means an individual who's worth $250 million or $100 million, a really rich person is what a family. So ultra wealthy individuals then started allocating more and more to alternatives. Now it's moving into the individual high net worth investor, right? The technical definition for accredited investor, net worth of about $1 million or more. And even with crowdfunding, I don't know if you all have heard of crowdfunding. Now some of these asset classes are available through different exemptions from the SEC to anyone, like no net worth requirement to take $1,000 and invest it into some of these crowdfunded projects. And so what that means is there's a huge amount of capital that really legally couldn't invest in alternative investments or really real estate outside of REITs. And now that gate is open. It's open wide. And so that's the democratization. Is our slide stuck?
No, I got it.
Oh, okay, you got it. I wanted to just show though, the tailwind that this industry has had. I mean, that's kind of that hockey stick, upward slope growth for any industry to grow by 7, 8, 9% a year, to have this amount of assets, $4.5 trillion to $12.4 trillion. That was last year. The growth is going to continue, right? So an industry of this size, $12 trillion industry, it's still growing by 6, 7, 8, 9% a year, depending on the asset class. And that growth is expected to continue for the foreseeable future. What does that mean? I guess for FIRE students, it means that you're in a good industry, right? Because it means that a lot of investors want to continue to invest more into private real estate, private equity, these alternative asset classes. So again, I talked about this a little bit, the democratization. It really is a cool thing that you can now invest in things now that you literally legally couldn't 20 years ago, right? In my opinion, this is a good change, right? Because it means that there aren't certain asset classes that only institutional investors or the ultra wealthy have access to. I think this is what, again, it's kind of a bipartisan thing. There's multiple arguments why this is a good thing. What's our next one?
So this one, by the way, was showing on the previous slide. We've got $12.4 trillion in alternatives as of the end of 2022, but only $1 trillion is held by individual retail level investors. So that has a lot more room to grow in that channel. That was kind of the purpose here. And then
if you think about the institutional investors I discussed, probably most of them probably don't have 60% in alternatives, right? A lot of times it's 30 to 50% in there. If the average retail investor has 2% of their portfolio in alternatives, and they get anywhere close to that typical institutional allocation, that 30%. So a lot of times advisors now, wealth management firms, they're talking about rethinking the 60-40. That's kind of the new buzzword, rethinking the 60-40 portfolio.
I think there's an article in the Wall Street Journal earlier this month that said, is the 60-40 dead? Something to that effect.
Yeah, you're going to see that headline for like another 5 years, just like regurgitated on a monthly basis. Because it's just, Mike.
Yeah, I think
That's true. And disclaimer here, if there's any private wealth people here or parents that do private wealth, I love that industry. But right now what's happening is the individual investors, folks like you are saying, well, I want access to private deals. I don't want to just go into mutual funds and ETFs. How do I do it? And now they're finding their way to different private, whether it's a syndicated deal or a fund or whatever it might be. And that money leaves the money manager, if you're hiring UBS or Goldman Sachs or Morgan Stanley, that leaves their account and they don't charge fees on it anymore. And now you're investing it one-off. And so what the wealth management industry is starting to realize is we better find a way to be able to get our investors, our clients, into private investments because our clients are demanding it. Gone are the days that I'm gonna buy, I love Heath Fear, but I'm not gonna just put my real estate allocation into Kite's REIT because that's the only way I can reach real estate. No, I'm gonna go and find one-off deals that you guys are doing or that you guys know about or that my fund runs. And I think that is changing the industry. So to your point, I think 60-40 is absolutely dead. I think it should be dead a long time ago. And I think we should democratize so that individual investors, people in this room can go and do individual deals. And that's kind of what's happening. And I mean, this is what you guys do for a living. So this is, I mean, I think you guys believe in what I'm saying too. And it's really happening in real
You're preaching
time.
to the choir, Mike. Yeah.
I halfway through, I realized that, wait a second, this is what we do.
I'm convinced I now love alternative investment.
But Andy, do you think individual investors will ever get up to that 30 to 50% alt allocation, or are there reasons
No.
why they can't?
I don't know. I don't think they will get to 30%. But if they get to 15% or 12%, that is still a huge tailwind when the base is growing from 1 or 2%. The reason I don't think they'll get to 30% or 50%, back to that time horizon, right? If you're a financial planner or an investment manager, you're managing an endowment fund, you need to know your time horizon, you need to know your constraints. That's all going to be in your IPS, your investment policy statement. Well, if I'm Harvard, I'm like, well, what's my constraint? Let's see, I have about $50 billion or whatever it is. Next year, I need $2 billion because I'm going to take about 4, 5, 6% of my portfolio every year to fund things, to give grants and scholarships. And the rest of it can stay illiquid. If I squint, I can like forever, right? The year after that, I'll need another 2 billion. And the year after that, I'll need another 2 billion. So I can just stay illiquid essentially forever. And honestly, the 2 billion or 3 billion I have every year in cash needs, probably my investments are just going to spit that off in income. So I won't even need to sell, cut into my principal at all. So like an endowment or an institutional investor, they typically have very long-term time horizons, that more predictable constraints. If you're an individual investor, like my mom, for instance, and you're thinking, well, I need this money to last my retirement, and I'll have various expenses to pay for when I'm retired. You know, you need to think about liquidity and your expenses and your time horizon very differently, right? Even if you're retiring at age 60 and you plan to live until age 90, it's a 30-year time horizon. That's very different than Harvard. When was Harvard founded? 1650 or whatever. So they're going to be around more than 30 years. So I think that to me, I don't think it's ever going to reach 30%, but it doesn't need to. It doesn't need to. There is one problem. We want to talk about the education gap though. We've tried to talk about, kind of give you a crash course in alternative investments in 60 minutes or whatever. It's pretty hard, right? Like there was a private equity, private credit slide, talked about all the different strategies within private credit. I didn't even have time to mention them, which is fine. Like we don't need to go into mezzanine debt or whatever. But think about if you're a financial advisor, you theoretically now need to know about all these different asset classes. Like I needed to know about stocks and bonds before, and insurance products, maybe annuities. Now I need to know about private equity and private credit and private real estate. And Andy from Wealth Channel told me I need to know about timber. Like what? It's a real problem, right? Because if you don't understand something, you should not be investing in it yourself. And if you're representing other people, if you're an institutional investment manager or a financial advisor helping individual people, especially retirees who may not be very sophisticated, you should not be investing in something that you don't understand. So that's the challenge with alternatives, is they're not easy to understand. I mean, I'm not even exaggerating or being fake humble when I say I barely know anything about them. Like I host a podcast called the Alternative Investment Podcast. And I'll have a manager of a private credit fund on the show and interview him. And I'll realize, wow, I know like nothing about private credit, because each of these asset classes, they have all of their idiosyncrasies, right? Just like real estate. If you're an industrial real estate guy or industrial real estate gal, you might just not know that much about office or these. So the fact that there are so many asset classes and subsectors, it's a real problem. And these data we have on this slide, this is wealth managers. These are professionals who have, finance degrees and who maybe have a CFP or even, CFAs probably get all this stuff. Maybe they have a CFP though, and they're saying, we don't even understand most of these asset classes very well. They're gaining some confidence now, I think, increasingly. There are more wealth managers dipping their toes into one or two of these asset classes. There's now Kaya, I had Kaya on my show. They have a certification, professional designation for alternative investments. But I think even they would acknowledge like it's in a way it's just scratching the surface. So, I think Jimmy, there are solutions to the education gap, but it's not some easy solution. It's not going to happen overnight.
Yeah, I'm gonna go back to the last one. I find it interesting that only a quarter of financial advisors think they're very knowledgeable in alts, right? 95% they're hungry to learn more about alternative investments. As we mentioned, it's growing. It's only going to continue to grow. Real estate plays a very large role in this alternatives investments universe. Here's some recommended resources that we like. iCapital, Kaya, Andy mentioned, and then Preqin has a ton of data on the alternatives investments universe. And then, of course, we've got to plug our own stuff, right? So Wealth Channel, that's our media and events company. We have platforms that cover alternative investments and Opportunity Zone specifically. We host multiple online events every year where you can come to Alts Expo via Zoom or OZ Pitch Day via Zoom and learn more about these types of investments and also discover investment offerings that are raising equity from high net worth investors. So Andy hosts the Alternative Investment Podcast. I host the Opportunity Zone Podcast. Third member of our team, Michael Johnston, Notre Dame class of 05, couldn't be here today. We love him though. He hosts Tax Efficient Investor, which dives into the tax efficient nature of different alternative investments. We did want to make this deck available in case anybody wants to grab it. That's a common question that we usually get at some of our events that we do is, hey, how do we download the deck? Scan that QR code or just head to wealthchannel.com/deck if you want to download it. And then Andy, you've got a rah-rah speech to give to kind of wind us up before we take questions.
I've been told that you have to end on something inspirational. So this is a permission slip. It's a little cheesy, but indulge me, right? I love Notre Dame. I love school. I'm not going to say anything negative about school, but I think one challenge about college and about being a student is you get in the mode of you're told what to do and then you do it, right? And you have to, you got to show up and take the test and get a good grade on the test or turn in and pay or whatever. In the entrepreneurial world, or really just in the corporate world or the world outside of school, no one really tells you what to do, right? No one told us to start ETF database. No one told us when to sell it. No one told us to invest in OZ funds, whatever. Our belief, I think both of us believe that everyone is an entrepreneur. Everyone needs to be an entrepreneur. I think that's increasingly true, actually, especially you guys starting your careers, seeing how many jobs or career changes are more common, more frequent throughout people's careers. And I strongly believe that the corporate world and the entrepreneurial world rewards initiative. And it was kind of cool, we were preparing this deck and this talk, just thinking about, because I don't think about it that much, where we started. I'm like, well, yeah, I guess I was 20. It was in Stanford Hall. That's where we started our business and no one told us to do it. So this is a permission slip. If you have a project you want to start, if you have a business you want to start, maybe it's a podcast, maybe it's a movie, maybe you want to write an article and contribute it to some journal. You don't need anyone's permission, but if you did, you have mine. And what does it mean? Everybody is an entrepreneur. I think increasingly in our world, even if you work for a corporate law firm or a giant corporation, which I don't think I could ever do, but God bless if that's what you're going to do, you have to have the entrepreneurial mindset. Right, you have to have a personal brand. I don't mean that in a skeezy post things on Instagram that says I do CrossFit or that's not what I mean by personal brand. I just mean things that stick out that you can hang your hat on. You can say, I decided to do that. I did it. I can tell you as an employer, people who take initiative, it's the number one thing that impresses. It doesn't need to even be anything in particular. right? So whether it's not, again, nonprofit, podcast, film, book, journal, take the initiative. It's okay that you're a student, do what your professors tell you. That's okay too.
I would like to co-sign that permission slip with you, Andy, because I'm a big entrepreneurial person too, and think failure is okay. Like failure is how you get better. People oftentimes are scared to be an entrepreneur because right? You're at Notre Dame. You've always succeeded at a high level. You've never actually failed anything. Entrepreneurs fail all the time. All of us have probably failed in an adventure. I know I've had multiple that didn't work, but
You just reminded me that we lied to everybody today, which is,
We included none of our failures.
yeah, we kind of
Yeah,
said
yeah.
Golf Channel was our 5th business. I think it was like the 15th.
Yeah,
So
true.
to your
Yeah.
point, Mike.
So entrepreneurial is
Yeah.
good. Before we thank them, I want to get some questions going. We have about 10 or 15, about 5 or 10 minutes left. Any questions? I know there are. Yeah,
I would just point out, opportunity zones, like, the lines are kind of arbitrary, like, I don't know exactly what Northern Avenue is, but hypothetically, the west side of the street is an opportunity zone, but the east side isn't. There's a lot of opportunities where, not really blighted stuff, they were one of the questions earlier, sometimes.
Yeah, no, you're right. Sometimes it's not really blighted. And these census tracts, I don't know how they draw them, and they are kind of gerrymandered a little bit. They do look kind of funny. They have funny shapes. Sometimes most or some of the census tract will be low income and blighted, and then you go over to the southeast end or whatever, and it'll actually be a pretty good economically revitalized area already. Also, another interesting quirk about the opportunity zones map is that a lot of the low income census tracts that were designated opportunity zones do happen to fall into where student housing is built, because students like you're poor, basically. Your parents probably aren't, or they may not be, and you may not feel poor, but technically you have no or very little income when you're an
And a
undergrad.
negative net worth when we look at your student.
Yeah,
loan.
that's true.
yeah.
So according to the Census Bureau, an area where a lot of Notre Dame students might live, or I don't want to pick on Notre Dame. There's a lot of areas across the country where you go just adjacent to a big campus, and it's where a bunch of students live, and it happened to get designated as an opportunity zone.
There were a couple that were
There are some
easy
head scratching,
designated,
yeah.
and it's kind of a footnote. Like, there were like 5 or 10 that I see, I'm rolling my eyes. I'm like, really? This is an opportunity. That's on the governor of that state.
Yeah.
I just gotta say, that's.
And it's a
Not
great
Jimmy's
arbitrage opportunity for the investor. If you can invest in a good area and not pay taxes or
Yep.
defer it.
No program is perfect.
Yeah, 7,200 different opportunity zones, I think we said, so.
Yeah.
Yeah, cool.
Is there any creative financing available for opportunity zones?
Creative financing. What do you mean?
Non-traditional loans or.
Well, that reminds me
I-
of Kelly Widget and the Epic OZ fund that
Yeah.
is not even, public until this week. I think they're just filing their registration. We have some friends who are GPs.
Mhm.
They're raising money from private investors and family offices. Sure, they're gonna get all kinds of traditional debt from banks. One of the 2 GPs, I don't know how she's so good at this. She's like a pro in getting government grants, which I'm like, I would rather hit my head against a brick wall than figure out how to get a government grant. But she's like the pro at, she has a track record of doing it. And so they've lined up all these projects that are getting like local incentives, aside from the opportunity zone program, that are getting local state-based incentives that are kind of sweetening the pot for their investors. So it's a combination of private capital, debt, and then they're getting other tax credits directly from local and state governments.
The South Bend project I mentioned earlier, I'm just remembering now, they did receive a tax abatement for the first few years from the city of South Bend. So it will eventually increase the rent rolls for the city, but for the first few years, just to sweeten the pot a little more, South Bend gave them some little kicker. There's also, is anybody familiar with the Community Reinvestment Act that banks have to adhere to? They recently redid the rules for that, where if a bank lends into a qualifying opportunity zone project, they get some CRA credits that helps the score of the bank. I don't really know a whole lot about that, but, and then if you go to grants.gov to talk about grants a little bit, there actually is an opportunity zone selector checkbox where you can see all the different grants that are available if you are an opportunity zone product. So hopefully that answers your question a little bit there. Yeah, but opportunity zone equity really can be just thought of as just one part of the capital stack for any type of redevelopment or ground up construction program. You can have your equity, you can have OZ equity come in, you can have non-OZ equity come into the deal, you can have traditional financing, non-traditional financing, grant money, tax credit money. Any other questions? We got one up there, Mike.
So for opportunity zones, after they become revitalized and improved, and maybe they're not as much lower income anymore, does that remain an opportunity zone? And if so, like, if it doesn't, does that affect your investment in any way or the tax incentives?
Yeah, great question. First of all, I did mention very briefly, although I didn't go into the specifics, this is a perishable program. It is currently set to expire after 2026. There's legislation that has been introduced into Congress that's likely to extend opportunity zones through 2028. The industry that I'm a part of, the opportunity zones industry, is hoping that's the first step in getting it made permanent. A lot of these programs start as having an expiration date, and then they eventually get made permanent. So that's what the industry is working on right now. We're 5 years in. It's gonna sunset in a few more years unless it gets extended. I think it's gonna get extended most likely because there's a lot of bipartisan support for it. But to answer your question, the goal of opportunity zones is to totally change that map, right? We want all those blue areas to not be opportunity zones anymore. So, a working group that I'm a member of, an industry working group that's put on by a big accounting firm that's active in the space, is working already on an opportunity zones 2.0 type of thing where, later this decade, they might reintroduce or introduce new legislation that would basically start the opportunity zones program all over again. Maybe at the end of this decade, early 2030s, where we would do that nomination project where the governors would essentially get another bite at the apple. Hey, okay, now what do you want to have designated as opportunity zones? And hopefully, I doubt all 8,700 plus those census tracts will get lifted out of poverty, but maybe a good portion of them will. They can go back to the well and try in some other areas that need it. The second part of your question was, what does that do for your investment? If you invest in an opportunity zone deal and then that area eventually no longer qualifies as an opportunity zone, you're okay, you're grandfathered in. I mean, because the government wants these areas to improve, so they're not gonna punish you for doing a good job there.
All right.
I guess coming out of university, I'm assuming you probably had a lot of pressure to just join a corporate job. What made you feel comfortable to like invest in yourself and invest in your own company?
Yeah, great question. I think I did take a job with my dad's company actually when I first got out of school because I needed our business. It was essentially we made money by what did we do? We built a bunch of websites and weird niches. We had a web publishing mini empire.
It was a side hustle, so we both got jobs.
Yeah, we both got jobs out of college because it was bringing in beer money. We'd go buy beer, have parties in our dorms. I mean, that was essentially it. Making a few $100 and then start making a few $1,000, but it wasn't enough to really earn a living and pay our bills. So we did get real jobs out of college for a couple of years before our side hustle kind of turned into a thing where all of a sudden we realized, well, wait a second, our side hustle is making us more money than our day jobs are. Why don't we? That's when
your 20s before you're married, absolute best time to do it. I mean, I have 5 kids now. I could only imagine a side hustle. Like that's how I'm like, oh no. But when I was 24, I'm like, what do I have going on? Right? Get home at 5, work with Jimmy on our side project.
Exactly.
Awesome.
Question right there.
I was just wondering, is there any like government policies or recognitions that displacement within these opportunity zones? That like after 2 years, if it's over there, that the people will originally back to like I sound.
There is not, no, and that's one of the biggest criticisms of the program, quite frankly. There is, unlike a lot of the other tax credit programs that have been around for a longer period of time, Opportunity Zones really doesn't have any guardrails. And that's a two-edged sword. On the one hand, it's great. Like anybody in this room can just go and start an Opportunity Zone fund You file one extra tax form with the IRS every year, and boom, you've got a qualified opportunity fund that can receive all these tax benefits. You don't have to go to the government and ask for permission. There's no red tape. So it's really easy to just start one up, start bringing in some OZ equity and build something.
And that's why I raised so much capital. so
And that's why it
fast.
raises so much capital so
There's a
fast.
minimum of red tape and bureaucracy with starting the projects, but that's the downside.
The second biggest economic development program in this country is the New Markets Tax Credit Program. It's capped at about $3.5 billion per year. Opportunity Zones has raised over $100 billion just in the first 4 years, I think, not including this. This is the 5th year now. But you're absolutely right. There's no guardrail in place to address that concern. I don't have the answer there. And I don't think this policy program has the answer. It's a great criticism of the program. But that is something that we need to consider as investors. What happens to the community afterwards? What happens to these residents that get left behind? There are some opportunity zone programs that try to address that. There are opportunity zone funds that try to address that by incorporating workforce training to at least, lift up some of these residents of these communities out of poverty, give them new skills. But quite frankly, some of these social problems are intractable and can't be addressed by any type of government policy program. They're too big. So I don't have a great answer for you, unfortunately. And you're right to point that out. It is one of the biggest criticisms of the program.
Jimmy and Andy are gonna stay down here for a little bit before we go to lunch, but guys, this was awesome. Really appreciate it.
Thank you, Mike.
Thank you, guys. We come down and ask questions. If you haven't picked up your papers and pick it up, I don't think there is around there.
Good job, man. Thank you.